broken market has no buyers. A shaken market does, but those buyers operate quietly while everyone else panics. Right now, the delivery data shows there are buyers. Large players are taking physical metal even as the paper price is collapsing. The same institutions capable of driving aggressive moves in the paper market are often the ones strong enough to accumulate when volatility forces weaker hands out. It's an old dynamic in finance. Panic creates opportunity. Those with liquidity benefit. Those without it feel the pressure. Now let's get to the most important part of this entire discussion, the historical pattern. Every major forced liquidation event in precious metals has followed a similar structure. In 2008, during the global financial crisis, gold fell more than 30% in a matter of months. The banking system was unraveling. Lehman Brothers collapsed. Emergency bailouts were happening. By every fundamental measure, gold should have been surging. Instead, it dropped. Not because the safe haven thesis failed, but because leveraged funds were being margin called. They had to raise cash, and when cash is needed urgently, everything gets sold. Silver was cut in half. Then the liquidation phase ended. Gold went from under 700 to over 1,900 in the following years. Silver ran from under 9 to nearly 50. The forced selling was temporary. The long-term repricing was not. In 2011, silver crashed from 49 to 26 in weeks, a 50% collapse. Margin requirements were raised repeatedly. Leverage unwound. Panic spread. The cycle repeated. In March 2020, when COVID hit, gold dropped from around 1,700 to near 1,470 in days. Stocks fell, bonds fell, crypto fell. Everything moved together because liquidity was king. Correlations went to 1, and within 5 months, gold was above 2,000. The pattern is consistent. A crisis pushes prices higher. Leverage builds. Something triggers forced liquidation. Everything, even safe havens, drops. Panic spreads. Then once margin pressure clears, fundamentals reassert themselves. I'm not predicting timing. No one can. I'm not calling a bottom. What I'm saying is this. Historically, forced liquidation crashes during major crises have been temporary dislocations, not permanent thesis failures. The real question has never been whether price eventually recovers. The question has always been who is still positioned when it does. Now, here's the most important point. A price crash does not automatically change the underlying fundamentals. Geopolitical tensions do not disappear because a futures contract drops. Supply dynamics do not shift overnight because leverage positions unwind. Industrial demand does not vanish because traders get margin called. What changed this week was positioning, not the physical properties of the metal. The world, if anything, appears more unstable than it was days ago, yet price is lower. That kind of disconnect historically does not persist forever. Markets can temporarily diverge from reality during liquidity events, but eventually they reconcile. If you're holding physical metal and watching the screen bleed, understand what is happening mechanically. The metal itself hasn't changed. The weight is the same. The purity is the same. What changed is the quoted paper price on leveraged exchanges where positions were forced out. A paper liquidation and a physical supply crisis are two separate forces that can occur simultaneously. If you were trading on leverage and got liquidated, that's the same mechanism impacting large funds right now. Leverage magnifies gains on the way up and accelerates losses on the way down. In extreme volatility, wars, rate uncertainty, liquidity stress, leverage becomes the most dangerous variable in the system. History shows that every major precious metals crash was intensified by leveraged unwinds. That isn't theory. It's documented market behavior. For those watching from the sidelines, here are the signals that have historically marked the end of forced liquidation phases. First, price finds a level and holds it for multiple full sessions, not hours, but days. Buyers defend it consistently. Second, selling momentum slows. Candles shrink, volume fades. Price begins to move sideways instead of cascading lower. That's exhaustion. Third, liquidity stress indicators calm. When emergency funding activity subsides, systemic pressure is easing. Fourth, watch physical market premiums. If physical demand remains firm while paper prices fall, that divergence can signal dislocation rather than structural breakdown. Right now, not all of those signals are confirmed. Yes, there may be green candles forming, but crashes rarely move in straight lines. They create lower highs and lower lows, they bounce, they give hope, then they test again. That structure, lower high, lower low, is what defines a downtrend until proven otherwise. Volatility like this produces emotional extremes. Relief rallies feel like salvation. Sharp drops feel catastrophic. Neither alone tells the full story. Structure does. If you're analyzing this market, focus less on emotion and more on mechanics. Understand the difference between forced liquidation and fundamental deterioration. Understand the role leverage plays. Understand how liquidity events distort price temporarily. The number on a screen is a market, quote, influenced by positioning and leverage. Physical ownership is different from a leveraged futures contract. Know the distinction. Stay disciplined. Stay informed. Volatility does not eliminate long-term realities, but it can severely punish poor positioning in the short term. In markets like this, education and risk management matter more than conviction alone.